Do you know how currency exchange rates are calculated? When we travel internationally, most of us will likely need to exchange our currency for that of the country we are visiting. The amount of money we will get for a given amount of our country's currency is based on internationally determined exchange rates. Foreign exchange traders decide the exchange rate for most of the currencies. They trade the currencies 24 hours a day, 7 days a week. There are two kinds of exchange rates: flexible and fixed. Flexible exchange rates change constantly, while fixed exchange rates rarely change. Most currency exchange rates are determined by the foreign exchange market, or Forex. Such rates are called flexible exchange rates. For this reason, exchange rates fluctuate on a moment-by-moment basis. Prices change constantly for the currencies that Americans are most likely to use. These include Mexican pesos, Canadian dollars, European euros, British pounds, and Japanese yen. These countries use flexible exchange rate. Most of the currencies in Middle Eastern countries rarely change. That's because those countries use fixed exchange rates that only change when the government says so. These rates are usually pegged to the US dollar. To keep the exchange rate fixed, the central banks in these countries hold the US dollars. If the value of the local currency falls, the bank sells its dollars for local currency. That reduces the supply in the marketplace, boosting its currency's value. It also increases the supply of dollars, sending its value down. If demand for its currency rises, so does the opposite. Interest rates, money supply, and financial stability all affect currency exchange rates. Because of these factors, the demand for a country's currency depends on what is happening in that country. First, the interest rate paid by a country's central bank is a big factor. The higher interest rate makes that currency more valuable. Investors will exchange their currency for the higher paying one. They then save it in that country's bank to receive the higher interest rate. Second is the money supply that's created by the country's central bank. If the government prints too much currency, then there's too much of it chasing too few goods. Currency holders will bid up the prices of goods and services. That creates inflation. If way too much money is printed, it causes hyperinflation. Third, a country's economic growth and financial stability impacts its currency exchange rates. If the country has a strong growing economy, then investors will buy its goods and services. They'll need more of its currency to do so. If the financial stability looks bad, they will be less willing to invest in that country. They want to be sure they will get paid back if they hold government bonds in that currency.